And I think that we're dealing with two things. One is just that if you really think about it, if I had said 13 months ago that we would be sitting here today and the Fed would have hiked 500 basis points in 9 months, plus or minus, you would have thought it was crazy. So we're sort of like coming into this phase of sobriety, trying to figure out how do we all do our jobs differently, and what does it mean for the investments that we've already put in the ground? And for me personally, I think the setup is that it amplifies tail risk. And so right now, I'm sort of somewhat quite cautious because I think there's a left tail risk, and I think Mike Wilson is here, but if you listen to Mike, who's been really right so far, the risk is that the S&P earnings are sort of with a one handle, 180, 185, and now all of a sudden the S&P is 3,200, 3,300. But then there's this right tail risk, which is that the Fed becomes dovish, everybody capitulates because it looks like things are slowing down. And now all of a sudden, though, you will have to deal with terminal rates that are going to be 4 to 5% on a more consistent basis, because if he lets off the gas now, then inflation kind of sticks around.
Yeah.
So both roads lead to repriced assets, just in very different path dependency. And those risks to me are a little heightened. And so I've tried to kind of be quite conservative and just, be down the fairway.
Now, one who has capital to invest can be conservative if they want, when you look at where the 2-year Treasury note is now, right? And so I think it's kind of interesting, for the first time in a long time, there is an alternative to equities, for instance. And so talk to me a little bit about that barbell, because I think the biggest risk right now is not that the market or investors come around to the fact that maybe Mike Wilson's right and maybe that S&P earnings are going to be down 10% this year to $180, and therefore there needs to be a lower S&P 500. I think the risk is that for whatever reason, we just reignite the risk asset bubble right here, because if we don't learn anything from the period that we were just in, and you've written about this, we're going to hit this Substack that you wrote last week here. If we don't have a reset, it just sets us up for the same sort of mistakes that we make again and again.
There's a lot to learn when you look at the past, which is that a high rate environment, at least in the area in which I operate, which is, technology businesses, we've actually counterintuitively built better businesses during periods of high rates. Yeah. And the reason is because there are fewer allocators that come to our part of the market, because you can find better risk-free rates, as you said, the 2-year, even down to T-bills and repo, quite honestly. So that's one thing. And then the second thing is that in the absence of this surfeit of capital, it forces each individual company to frankly just be better managed because there's less money. And so we become, as an ecosystem, more intolerant of excess. And all of that just creates better run businesses. And so we haven't had that cycle for probably 14 or 15 years. And so we desperately need it, because if you look inside of a lot of technology companies, they're unfortunately rotting from the inside out, right? They've had a period where they've been able to raise successive amounts of capital to fund a valuation creep that frankly won't translate into what the actual money is you're going to get back. In our industry, there's a couple of dirty little secrets, or like the dirty soft underbelly. One of them is that only 10% of all of the firms in our asset class actually generate real returns. 10%. Which means 90% are basically floundering around burning money. The other thing is that we have always consistently generated a high single-digit DPI, so like 1.7x is like the 30-year average on distributions. Yet we are the worst offender when it comes to showing people, like you guys, paper markups or TVPI. So there is this dance that this industry has been able to play because rates have been at zero. So as investors, the asset class, I think, is very challenged in order to generate real returns now. The companies that we funded have, as a result of all this excess capital, been more poorly run than otherwise. And so we need to course correct. So we need these rates to be sustained for 5, 6, 7 years, frankly, hopefully, in order to really flush it through the system.
What did you see, back in 2018, it was Fed Chair Powell's first year there, and he started raising interest rates right off that zero interest rate bound that had been there since the financial crisis. And they were kind of, I think they used the term on autopilot, raising like 25 basis point every other meeting. They got to, I think, 3.25%. And remember what happened in Q4 of 2018? The S&P 500 went down 20% in a straight line, and then they pivoted, okay? Exactly. And I think, so talk to me about like, what were you seeing in the private markets then, and how did that rate increase and the pace at which was much steadier, you know what I mean? It was not the way that they went up this year. I'm like, what were the impacts on venture back then? There
was none. And the reason is that in that time, the narrative was that China was turning over. And so people needed to reestablish some amount of baseline global growth. And so they thought if China turns over and the US now all of a sudden raises too much, we're going to be in a lot of headwinds. And so Powell capitulated, but it turned out that China actually faded that perceived theoretical recession risk. And so all of a sudden the floodgates opened because rates were low here. You couldn't find any real growth anywhere. And we were at that period of the market where so many people had been sitting on the sidelines and effectively on the outside looking in, that they ran into the riskiest assets. So, you know, technology ripped, crypto ripped, SPACs ripped. Everything that was on the far edges of the risk curve were really well bid to a point that now looking back clearly was unsustainable. But it's explainable in the sense that we gave folks no real other recourse because they were in the 8th or 9th year of no returns anywhere else.
Yeah. Do you think as investors, we just kept on looking for new things to invest in? So you just mentioned SPACs. Obviously, you were a prominent player in that. And you know, when I first met you, it's not like you were some Johnny come lately. I mean, you were bringing a company, SPAC, Virgin Galactic, right, in 2017. And so talk to me a little bit about that, because there was also, obviously, crypto. There was, you know, Snap went public in 2017. It was wildly unprofitable then. It's still unprofitable now, all these years later. What's the post-mortem on some of these things? And obviously, crypto had this huge retail move, you know, that started, obviously it crashed in 2018, but started to reflate in 2020. What's your like look back on those risk assets right now, and what survives out of that?
So, you know, we, in our history from founding, we've had these things where we've had these major themes that we've always invested in, which is early stage venture, largely in healthcare and software and deep tech. And so that's been a consistent theme, and recently energy transition. That's been our bread and butter. But every few years, it has turned out that we sometimes go a little off-piste. And you know, in the early 2011, I went off-piste and I made a huge bet in Bitcoin when it was $80 a coin. It just seemed like just an unbelievably massive risk reward. We did the same thing in the mid-2000s. We did it in SaaS. We did it in deep tech. And SPACs, you know, we stumbled into this thing because we wanted to raise money for a bunch of our companies that were extremely capital intensive. And we demonstrated something that in a moment just caught a lot of wind. So yeah, as you mentioned, you know, we did 6 of them. I think there were 650 of them just in 2021. So we're, you know, about 1% of the market. You know, I think we bought good companies well. I think we sold well, quite honestly. But it's one of these things where it was fueled by a moment in time of just enormous excess liquidity. And now I think we're sort of back to basics. So for us as an institution, we're kind of back to early stage venture. Who knows, we may go off-piste at some point to really try to ton it. That's our job as investors, right? Is like, we allocate risk well, we maintain top quartile returns, but when there's a window, you know, I'm the largest LP in my fund, so when there's a window, I go for it. And that was a moment where we tried to go for it.
So as the largest LP in social, I mean, when you think about this refocus on early stage, talk to me about, is it just the environment? Is it about some things that you've learned over the last few years? Is it where you think that you can have the most impact on these companies? And then to your point, if things get back rolling again in a couple of years, maybe that's when the growth investing comes back a little bit.
Yeah, I think the problem with growth investing, just to give you some anecdotal data, like at the end of last year, I looked at 7 converts. And these were all extremely well-known companies that all of you would know on a first-name basis. And they all came to me trying to raise a convert. And I said, well, here's the real market clearing price of these companies. And none of them took my money. And instead they did a convert to basically deflect and kick the can down the road on valuation. So we're in that point in the market where all the boards of these private companies refuse to budge on valuation. And the reason is because it impacts meaningfully their DPI or their TVPIs that they've given to LPs. And so it's a very difficult part of the private markets right now to invest in, because you will not be allowed to do true price discovery because nobody wants to take the real hits. The best companies will do it. I mean, I think you saw today that Stripe may take a 50% down round. That's probably the best technology company in Silicon Valley proper being built right now. So they'll do it. Klarna did it. In fact, it's so interesting that it's all, the through line there is Sequoia, which is an extremely disciplined and incredible organization, so they're able to enforce that discipline. But other companies, other venture funds, they don't want to look at the TVPI decay. And so it's uninvestable, quite honestly. On the other end, early stage venture has always been where the real gross dollar profits are made. And if you overlay that with a rising rate environment and you regress that back 30 or 40 years, in fact, we did it looking back 60 years, the most incredible opportunities to make money are actually when rates are rising in early stage venture. That's just the historical artifact if you look at public companies in size. So, we said very explicitly, okay, no more growth. The default answer right now is going to be no, we're not going to touch it. But we're going to continue to sort of over-index into early stage and do as many good deals as we can see and, let the chips fall where they may.
What do you think, if you just think about public markets, for instance, some of these, high valuation names without profits, they started correcting, early 2021, right? So by the time that the NASDAQ topped out in late 2021, the S&P topped out the first week of January in 2022, there were bear markets all over the place, right?
Yeah.
And so because a lot of people, were looking at the indices, they were masks, some of the devastation, crypto had already turned over, that sort of thing. What do you think some of the signs of the bottom in private tech will be? Because to your point, if you're seeing some of the leadership, the Stripes, take these big hits, there's got to be some devastation to happen under much smaller names that are out there at big valuations.
I think when limited partners really become disciplined about keeping people honest about distributions, because in a moment like this, when your asset allocation goes upside down, the most important thing are who can generate DPI, who actually gets money back into your pocket. Forget paper markups, because they're kind of not really worth the paper that they're printed on. Where are the distributions so that my actual assets can be more right-sized? They are the ones that I think start this trend of bottoming. Because what will happen is you'll go to the organizations that have had the most consistent TVPIs with the most inconsistent DPIs and say, I can't work with you anymore. Because this is now just money bad. And when those folks leave the market, those companies now become more prone to get repriced accurately, because that set of GPs will say, I need to return money. And that's where guys like us can step in with clean balance sheets and lots of money to go and say, okay, let's go and reprice these. I honestly think that's like 3 years away.
Yeah.
I thought it was going to be 3/4 away. At first when we were thinking about like, how much capital are we really going to be allocating over this next period, we cut it by 2/3 because we just didn't see the opportunities in the late stage anymore.